In this video, we're diving into chapters 6 and 7 of The Intelligent Investor by Benjamin Graham, the man Warren Buffett calls his greatest mentor. These two chapters are all about the enterprising investor, someone who's ready to go beyond the passive, buy and hold mindset to actively seek out better returns. But with that opportunity comes responsibility. Chapter 6 is your warning manual, a clear list of pitfalls to avoid if you want to protect your money. And Chapter 7 is your playbook for success, practical strategies to find undervalued investments and build wealth with confidence and discipline. If you've ever wondered how serious investors separate themselves from the crowd without falling into the trap of speculation or hype, this is the episode you need. Let's break it all down, step by step. The Enterprising Investor. Lessons from Chapters 6 and 7 of The Intelligent Investor. Enterprising versus defensive investors. Setting the stage. Imagine two types of investors at the starting line. The first is the defensive investor, content with a safe and passive approach, a simple mix of reliable stocks and bonds, minimal fuss. The second is the enterprising investor, eager to put in extra time and effort to achieve better than average returns. Benjamin Graham, in The Intelligent Investor, explains that the key difference between them is the work and analysis the enterprising investor is willing to do in order to find opportunities. But Graham makes one thing clear. Even the most enterprising investor should begin with the same solid foundation as a defensive one, a balanced portfolio of high-grade stocks and bonds to anchor their finances. Only on top of that foundation does the enterprising investor build a more active strategy. Now, how should an enterprising investor proceed? Graham dedicates Chapter 6 to a negative approach, essentially a list of what not to do. Think of it as learning to avoid the quicksand and trap doors on your investing journey. Then, in Chapter 7, he shifts to the positive approach, outlining what to do to uncover bargain opportunities and succeed as an active investor. Let's walk through these chapters. First, dodging the pitfalls, then mapping out the path to smart, proactive investing, all in a narrative that's easy to follow, even if you're new to the market. The negative approach. What not to do, Chapter 6. Graham starts his guidance for enterprising investors by emphasizing a negative approach, avoiding mistakes and pitfalls before chasing profits. It's like a seasoned coach telling you, first learn the bad habits to steer clear of. This approach stems from a core principle. If you lose money by taking foolish risks, it can take a long time to recover, so don't even go there. By eliminating what not to do, you improve your odds of long-term success. Here are the major pitfalls Graham says an active investor must avoid. Don't speculate. Invest rationally, not emotionally. One of the biggest traps is turning investing into speculation. Graham warns that an enterprising investor must never confuse the stock market with a casino. Speculative behavior, like buying a stock simply because its price is going up or because everyone else is buying, is a sure path to trouble. Market fads and hot tips can tempt us into impulsive decisions. The intelligent investor, however, remains cool-headed and analytical. Graham insists that every stock you buy should be backed by sound reasoning and research, not a gamble on short-term market moods. Closely related is the temptation of market timing, trying to jump in and out of the market to buy low, sell high, based purely on predicting market swings. At first glance, timing the market sounds simple. Why not get out at the peaks and back in at the bottoms? In reality, Graham argues, it's nearly impossible to do consistently well. To successfully time the market, you'd need a crystal ball to know the future, something no investor has. Even professionals struggle with this. As Graham notes, what seems like a bright idea from looking at past stock charts quickly falls apart in real-life unpredictability. So, rather than trying to time the market's every zigzag, the enterprising investor focuses on long-term value. In short, don't try to outsmart the market's short-term movements. Odds are you'll just outsmart yourself. Beware overconfidence and ego. With the desire to be enterprising can come a dangerous overconfidence. It's easy to overestimate your skill or knowledge and start taking on risky bets thinking you can't lose. Graham gently reminds us that humility is an investor's best friend. The market has a way of humbling those who think they're infallible. Staying wary of your own ego is crucial. It keeps you researching facts rather than indulging in wishful thinking. Many of Graham's followers, including legendary investors, emphasize this point. Check your ego at the door. The moment you believe you've got the magic touch, you're likely headed for a lesson in humility. So stay humble and stay alert. Always question your assumptions and be willing to say no to investments that you feel are great but can't justify with hard evidence. Don't chase the hottest trends or new game-changing stocks. Another pitfall is blindly following market trends or the latest hot stock. As an enterprising investor, you might feel pressure to jump onto whatever is trendy, whether it's a booming industry, a hyped-up tech startup, or the newest IPO, initial public offering. Graham and his later editor Jason Zweig have strong words of caution here. IPOs and trendy newcomers are often traps. Why? These stocks usually debut with a lot of salesmanship and hype, in favorable market conditions for the sellers, meaning when optimism and prices are high. By the time an average investor hears the buzz and rushes in, the stock is likely overpriced relative to its actual business value. In fact, Zweig quips that IPO might as well stand for "it's probably overpriced." It's not that every new stock is bad, but Graham's advice is to be extremely wary. If you buy a popular new issue just because everyone's talking about it, you're following the crowd, not the facts. Rather than investing, that's speculating on popularity. Graham suggests that if you're itching to invest in a young company you truly believe in, do your homework. Make sure you have solid reasons beyond "everyone says it's great." And even then, a smart move is often to wait for the hype to settle. History shows that if you wait a while after an IPO, possibly until the next market downturn or a few earnings reports later, you might be able to buy into that company at a price that actually makes sense. In essence, don't buy into a story just because it's exciting. The more excitement surrounding an investment, the more you should pause and scrutinize whether the optimism is justified. Avoid low-quality deals, the high-yield trap. Graham also warns against the allure of investments that promise very high income or yield at the expense of quality. For example, junk bonds, low-grade bonds, or certain preferred stocks often offer tempting interest or dividend rates. It's like someone offering you a 10% yearly return when safe bonds yield only 5%. Sounds great, right? The catch is that those generous yields usually come from companies in shaky condition. Graham emphasizes that an intelligent investor should not buy second-grade bonds or preferred stocks just for their high yield. If a company is willing to pay sky-high interest, it often means nobody would lend to them at normal rates, a red flag about the company's health. In bad economic times, these lower-quality securities tend to suffer severe sinking spells, dropping dramatically in price and even risking default. Sure, they might recover later, but Graham notes that individual investors rarely manage to hold on through the turmoil and sell at a profit when or if things improve. More likely, you could face a permanent loss of capital, which is the opposite of intelligent investing. His blunt advice: don't reach for yield at the cost of your principal. It's better to accept a modest return from a solid investment than to chase a high return from a dubious one and lose your shirt. In the same vein, be cautious about foreign bonds or exotic investments that promise higher returns. Graham in his era suggested keeping money at home in familiar markets, because when you invest abroad, especially in foreign bonds or loans, you may lack legal protections if things go wrong. The specifics have evolved since Graham's time. Today investors do buy foreign stocks and bonds, but the underlying lesson remains. Stick to what you understand and where you have some protection or recourse. If you venture into complex or distant opportunities, do so carefully and in moderation. The enterprising investor isn't barred from exploring, just don't bet the farm on something you can't fully grasp or control. Summary of Chapter 6. First, do no harm. Chapter 6 is essentially Graham's way of saying, avoid shooting yourself in the foot. An enterprising investor must guard against overexuberance, fads, and the seduction of quick profits. By steering clear of speculative behaviors, resisting the temptation to time the market, and refusing to chase high-risk, high-hype investments, you set the stage for success. It's a bit like personal development advice. Avoid negative influences and bad habits so you can focus on positive action. Graham knows that if you plug the holes in the boat, you'll sail much farther. With those warnings in place, he then turns to the positive side. What proactive strategies can the enterprising investor use to beat the market without falling into those traps? The positive approach. How to succeed as an enterprising investor, Chapter 7. After clearing the minefield of pitfalls, Graham uses Chapter 7 to map out how an enterprising investor can approach the market to achieve better results than the average defensive investor. This is the positive approach, a focus on sound, proactive strategies for stock selection and portfolio management. Graham's core message here is both inspiring and sobering. Yes, an enterprising investor can do better, but it requires discipline, knowledge, and a strategy that makes sense. It's not about sheer cleverness or luck, it's about hard work and a proper mindset. Standing apart from the crowd, rational and different. One theme Graham stresses is that to reliably outperform, you need a strategy that is rationally sound and different from what the crowd is doing. In other words, just doing what most investors do won't give you above-average results. You have to zig when others zag, but only in ways that are logically justified. It's not contrarian for contrarian's sake. It's independent thinking guided by facts. This might mean looking for opportunities in places others ignore or shun, as long as those opportunities meet strict quality and valuation criteria. Graham presents several possible ways an active investor might try to beat the market. And then he evaluates which actually hold up to those two tests, soundness and being different. The approaches he discusses include 1. Market timing. Buying low, selling high in practice. Attempting to actively shift between stocks and cash to catch market swings. 2. Picking growth stocks. Focusing on companies with fast past growth and high future expectations. 3. Hunting for bargains. Finding stocks that are undervalued or mispriced relative to their true worth. 4. Special situations, workouts. Investing in unique circumstances like mergers, acquisitions, or reorganizations that could unlock value. These 4 sound like classic ways to make money, but Graham doesn't approve of them equally. In fact, after careful analysis, he dismisses or cautions against 3 of the 4, leaving only one as a strongly recommended path. Let's see why. Market timing, or what Graham calls buying low and selling high, gets a thumbs down. We touched on this earlier, it's just too close to speculation. Graham had serious reservations about formulaic timing plans. The market in the real world doesn't move in neat, predictable patterns, so a formula that tells you when to get in or out is likely to misfire. Sure, if you're very lucky or occasionally intuitive, you might improve returns by timing, but you also risk doing worse than average. Graham's advice: don't count on market timing as your main strategy. It's a lot harder than it sounds, and it fails the test of being reliably sound. Next, investing in glamorous growth stocks, companies that have grown quickly and are expected to keep shooting up. This sounds sensible. Who wouldn't want a piece of the next big success story? The problem, Graham points out, is twofold. First, you'll probably pay a steep price for that rosy future. Popular growth stocks often trade at very high price-to-earnings ratios because everyone is optimistic about them. Buying them means betting on continued perfection, and perfection rarely continues indefinitely. Graham famously observed that unusually rapid growth tends not to last forever. As a company becomes larger and more successful, maintaining that extraordinary growth becomes harder and harder. If the company's growth slows even a bit, an overvalued stock price can tumble. Second, predicting the future is precarious. Even the best investors armed with research can be wrong about a company's prospects. Graham humbly notes that specialized investment funds with teams of experts have a tough time reliably picking winning growth stocks. So an individual investor should be cautious about assuming they can do better. This isn't to say you should never buy a growth company, but don't do it just because it's popular or without a margin of safety. Graham essentially advises the enterprising investor not to make growth stock picking the primary game plan, especially when those stocks are already priced for perfection. How about those special situations? These could be events like mergers, acquisitions, spin-offs, or companies in bankruptcy restructuring. Cases where there might be hidden value if you understand the legal and financial complexities. Graham acknowledges that there can be money made here, but he issues a gentle warning. Special situations are not for most people. They require specialized knowledge, lots of time, and the right temperament to navigate uncertainty. Markets can undervalue a company tied up in complicated proceedings, like a distressed company or a corporate breakup, but only a small number of investors will have the skill to accurately assess those and the patience to see them through. If you're a true expert or have a knack for this niche, it could be an avenue. But for the typical enterprising investor, Graham suggests focusing elsewhere. In short, special situations are advanced maneuvers. Beginners and intermediates are usually better off avoiding these tricky waters unless they've done significant homework. This brings us to the strategy Graham enthusiastically endorses for enterprising investors, searching for bargain stocks. This is the classic value investing approach. A bargain in Graham's terms means a stock or bond that is worth considerably more than its current price. In other words, it's undervalued by the market. Graham describes a couple of ways to spot a bargain. One method is to estimate a company's future earnings and apply a reasonable price multiple to those earnings. If the stock is priced much lower than that, it might be a bargain. Another method is to imagine what the whole business would be worth to a private buyer. Look at the company's assets, especially its net working capital and cash on hand, and its earning power. If the stock is selling far below what the business is fundamentally worth, that's a strong signal of a bargain. Graham often looked for stocks trading at less than their net current assets, a metric known as the net-net approach. These were the ultimate bargains, priced so low that just liquidating the company would give you more value than buying its stock. One category of bargains Graham highlights is the relatively unpopular large company. This means a big, established company that's going through a period of unpopularity or temporary trouble. Maybe it had a bad quarter or an industry downturn, and investors have soured on it for now. Because it's currently out of favor, its stock price may have dropped to an attractive level. Yet, being a large firm, it likely has the resources and resilience to recover over time. When it does, the market often reacts positively and more quickly than it would for a small, obscure company. In Graham's view, focusing on solid companies that are down on their luck can be a conservative but rewarding strategy for the enterprising investor. It's psychologically tough. You must go against the crowd's current opinion, but that's exactly why the opportunity exists. You're buying when others are pessimistic and selling later when others become optimistic again, which is the very definition of buy low, sell high. Another type of bargain is what Graham calls a true bargain, a stock priced at least 50% below its intrinsic value. These are rarer gems, but they do appear in the market from time to time, often in bear markets or recessions when fear is rampant. For example, during a market crash, a company's stock might plummet to half of the value of its assets or earnings. An enterprising investor who has done their homework might recognize that the company's actual business is sound, and that eventually the price should rise closer to its real value. Buying at such a steep discount provides a cushion. Even if your estimate of the company's value is a bit off, a 50% margin of safety gives you a lot of leeway. It also ups the odds that you could see a significant gain if your analysis is right. Graham loves these scenarios because they stack the deck in the investor's favor. Limited downside, plenty of upside. So the positive approach for enterprising investors boils down to this: work hard to find undervalued stocks, purchase them with a margin of safety, and be patient enough to wait for the market to recognize their value. It requires being more analytical and diligent than the average investor. You might dig into financial statements, study industry conditions, and even read special reports. But that's the enterprising part. You're effectively saying, I'm willing to put in extra effort and think independently to find opportunities others have overlooked. Discipline and temperament. Buying low and selling high in practice. Finding bargains is one thing, capitalizing on them is another. Graham stresses that an enterprising investor not only needs analytical skills, but also the right temperament and discipline. Practically speaking, you must be willing to buy when the situation looks bleak, when a company or the market is out of favor, and later sell when everyone else is bullish. It sounds straightforward: buy low, sell high, but in the real world it's emotionally challenging. When prices are low and pessimism is high, you'll feel fear and doubt. When prices are soaring and everyone is optimistic, you'll feel the tug of greed and the fear of missing out. Sticking to the value investor's contrarian approach means constantly counteracting those emotions. As Graham cleverly puts it, the intelligent investor is a realist who sells to optimists and buys from pessimists. In other words, you profit by having the courage to sell when the market is euphoric. Optimists are willing to pay high prices then, and to buy when the market is depressed. Pessimists are desperately selling at low prices. This mindset, being a realist who stays grounded in value rather than getting swept up in market sentiment, is a cornerstone of Graham's philosophy. To maintain this discipline, Graham advises treating your investments as a business. Do your analysis with the seriousness of someone buying an entire company, not just a piece of stock. If you've determined a stock is a bargain based on solid facts, have the conviction to stick with it, even if the price gyrates in the short term. Likewise, if the price rises to a point where it's no longer a bargain, perhaps it even becomes overpriced due to market excitement, be ready to take your profit or at least reevaluate. The enterprising investor's goal is not to chase every rally or predict every crash, but to systematically buy quality assets at comfortable prices and sell them when they become fully valued or overvalued. It's a patient, principled approach, more like a marathon than a sprint. Wrapping up Chapter 7, Key Takeaways. Chapter 7 provides a game plan for the active investor. The key practical lessons include: focus your efforts on finding undervalued stocks rather than trying to time the market or pick the hottest growth sensations. Use a two-pronged test for any investment. It should be fundamentally sound and something not already embraced by the majority. Be prepared to dig into research, understanding a company's business, finances, and value, because that's your edge over a passive approach. And perhaps most importantly, cultivate the right temperament. Be resolute, patient, and immune to crowd-driven fear or euphoria. The enterprising investor's advantages come from their willingness to think and act differently than the herd, but always with rational criteria. Conclusion: the enterprising investor's mindset. Chapters 6 and 7 of The Intelligent Investor paint a clear picture of what it takes to be an enterprising investor. In essence, such an investor is more active, more analytical, and more opportunistic than the defensive, passive investor. But they are also keenly aware of the dangers of speculation and emotion. Graham's core theme is that an enterprising investor earns the right to higher returns by putting in extra effort and exercising greater discipline. It's not about taking wild risks or having a guru-like ability to foresee the future. It's about avoiding the big mistakes: greed, hype, fear, overconfidence, and consistently applying sound strategies to find value that others miss. For a general reader or viewer interested in self-improvement through investing habits, the wisdom here goes beyond just money. Graham is essentially teaching patience, independent thinking, and self-control. The enterprising investor must train themselves to resist impulses, whether that's the impulse to join a speculative frenzy or to flee in a panic. They develop the habit of doing their homework, making decisions based on data and logic, not headlines or hunches. And they learn to stay calm and rational when others are swinging between greed and fear. These traits are like muscles that get stronger with practice, and they serve well not only in building wealth but in making any big life decisions. In summary, Graham's enterprising investor is an active yet cautious adventurer in the stock market. Chapter 6 teaches them the negative roadmap, what swamps and quicksand to steer clear of, speculation, market timing fantasies, trend chasing, and low-quality temptations. Chapter 7 then offers the positive roadmap, where to actively search for treasure in undervalued, solid companies that others have passed by, and how to conduct this search with rigor and discipline. By following these guidelines, the enterprising investor stands apart from the crowd in a very intentional way. They are not swept up by market mania, nor paralyzed by market gloom. Instead, they move steadily, thoughtfully, and decisively, guided by the principle that investing well is a matter of both character and analysis. Ultimately, the lesson from these chapters is empowering. If you cultivate the right habits and mindset, you can truly make the market serve you rather than mislead you. Graham gives us a timeless recipe for better investing habits, one where common sense and diligence trump recklessness and speculation. This is how an enterprising investor can achieve success while others chase illusions. It's not a get-rich-quick scheme. It's more like a path to grow rich safely. And that, in the long run, is the most reliable path of all for those seeking financial growth as a form of personal development. Thanks for watching. Now that you understand how the enterprising investor avoids common traps and seeks real opportunities, you're already ahead of most people out there chasing quick wins. In our next video, we'll continue the journey with chapters 8 through 10. We'll cover how to handle market fluctuations without panicking, what you should know before trusting your money to investment funds, and how to wisely choose or even avoid financial advisors. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you don't miss the next part of the Intelligent Investor series. And let us know in the comments, what's one habit you're working on to become a smarter investor? See you in the next video.